We are wrapping up 2022 quickly, and for those of you who have received some natural gas royalties or anticipate some or more royalties in the near future, this might be perfectly timed for you. This shouldn't take long, but I'm going to run through 7 important issues that as a royalty owner, you should be paying attention to. And as we're heading into 2023, it marks the perfect time for you to sit up and pay attention to these important details. Having your financial matters organized and efficient could just save you thousands of dollars or more over time. And who doesn't want that? Welcome everyone to another Blue Collar Wealth video. We sure hope that you find these things really helpful, and because one of our goals here is to help you keep more of whatever's coming through your cash flow at the moment, and also to help you reduce the chaos that sometimes gets overwhelming. We're going to break this video into 2 parts, and the first part is going to be more about keeping what you make, and part 2 will be focused on how specifically to handle those checks as they're coming in each month. I think you're really going to like part 2. But let's get right into it here. As I said, I'm going to run through 7 items that are super important for you to pay attention to. We're going to focus on taxes, deductions, potential liabilities, and your family limited partnerships, LLC, or other legal structures that you may have in place. Okay, right out of the gate, we're going to talk about tax review. Regardless of when you're listening to this video, it's important to distinguish between a tax review and a tax projection. Right now, I'm talking about a tax review. That means taking a look at your last completed tax return. What does it look like compared to the year that you're in right now? How is this year shaping up compared to how you did your return last year? Probably a bit different. Are you receiving new royalty income or far more royalties than in previous years? How is that affecting the other things that are happening in your life? How is that affecting your tax bracket? Although that extra income is always welcome, right? Is it phasing you out of any deductions that you've had in the past? Most of us don't fully understand all the ins and outs of our tax returns, which is why we usually hire a tax professional to help us prepare that return each year. And maybe even to help us with our quarterly estimated taxes. I hope you're paying those along the way, though. But these are simple questions to most of those professionals. So if you haven't done so already, I highly recommend stay in close touch with your tax professional and make sure they're aware of the royalties that you're receiving and anything else that may be different as you move throughout the year, especially compared to previous years, because that's all they know until you tell them different. If for some reason you're not getting that kind of communication with your accounting pro, you're always welcome to have us take a quick look at it and run it through our systems to at least double check as to whether or not there's anything more that you could be doing. One of the things that we pride ourselves on here at Stonehouse is our communications between our clients and their other professionals that they work with. If you'd like us to run your numbers through our system and then reach out to your accountant directly on your behalf, we could welcome that opportunity, and we would. It gives us, we always like it because it gives us a wonderful chance to show you the depth that we go with our clients, and also gives us a chance to work with your tax pro and continue to build some great relationships like we already have with other people in our business. Now, let's talk about tax projections. This is often very overlooked, but something that we feel is quite important, especially for royalty owners, since those checks are often so unpredictable. And what I mean by the word projection, it's the ability to look out into the next year at what your royalties might amount to and what effects that will have on your tax liability upcoming. Here's an easier way to look at it. Instead of scrambling at the end of any given year because you were fortunate enough to receive a large amount of royalties, the act of projecting out and doing some tax planning ahead of time will allow you to set things in motion at the beginning of the year and easily tweak those actions and numbers as the year progresses. Think of it maybe this way. If you're projecting that you were to receive an extra $100,000 of royalty income next year, yet everything else in your life probably remained the same, your current income from your job, your retirement contributions, your expenses, and then all of a sudden, halfway through the year, the royalties completely dropped off. Or maybe they went in the other direction and some new drilling happened and the royalties went way up substantially. That tax planning would make it very easy for you to make mid-year adjustments along the way, so you won't find yourself in a really tough spot at the end of the year trying to scramble to find money to pay for taxes that you didn't know you even owed, or to find money to move around for deductions that you didn't even know you could take. We love doing the tax planning because it folds right into the tax review, as I mentioned earlier. Using your last year's tax return, we get a very quick picture of what your tax life looks like. We use last year to look at the year we're in now, and then we run scenarios to look at those projections that are possible in next year's return. The combination of this really gives you a good visual understanding of where you're getting hit with the taxes and what you might be able to do to minimize those taxes broken up over a whole year's time versus doing it all at the end of the year, as I mentioned. Now let's talk about the third item you can look at as you close out this year and head into next year. And this one is tax deductions that you can apply to this current year that you're in. Almost any accountant will tell you that it's not ideal to wait until the last minute here, but so many people do. And why do we think it's better to do it throughout the year versus waiting all up until the end of the year? It's one of the most obvious things that you can do to offset income in any given year is to maximize the amount of money that you contribute to a retirement plan, if that's available at your current employer, or even if you're self-employed and you have your own plan at your business. The reason we like to fund those things throughout the year is that, plain and simple, it's just much easier to manage your cash flow by contributing a little bit each month versus trying to write a giant check for it at the end of your tax season. I think we've probably been there before, and that's always hard to do. But retirement plans aren't the only possible deduction that's out there. There's quite a few. Like, just to name a couple, health savings accounts for taxpayers that are still working and on a high deductible insurance plan, 529 plans for your kids and your grandkids. There's also charity, business deductions, if those are applicable, harvesting tax losses from your portfolios in any given year, and even more than that. As if I needed more reason to suggest that you work with an accounting pro. Get set for next year. This is a fantastic time for getting set up for next year. Why? Here's why. If you're expecting royalties to be a bigger part of your financial picture in the upcoming year, you're going to end up paying tax on those royalties. And there's only so much you can do to get that tax bill down. But the obvious positive there is that after taxes, you're very likely going to have more cash on hand to help you cover your month-to-month expenses and even save excess into something else or pay down debt. But let's not forget a very important thing that is still happening to you, which is that your paycheck is still coming in, right? If you're working. But since you have that extra cash flow, do you really need that full take-home paycheck? I'm not suggesting that you give it back to your employer, although I'm sure they'd love that. I'm suggesting that you defer more of that paycheck than you ever have in the past. In other words, if you don't need that money to live on this month or this year, then why not contribute it to your retirement plan for some time down the road? Doing so will reduce the amount of taxable income that you need to report on your tax return that year, which basically means more money in your pocket and less in the tax man's pocket. So how do you do that? Are you aware of how much you can contribute for the upcoming year, for, in this case, for 2023? Those numbers are going up for many people. And if you're over the age of 50, the catch-up provisions are increasing as well, which means that you can invest even more into those retirement plans. For example, the max contribution for someone over the age of 50 in 2002 into a 401k was $27,000. For 2023, that contribution limit is moving up to $30,000. again, for age over 50. Now, I want to make sure that I'm clear and careful as I talk about this because not everyone has access to a 401k, but there are plenty of other different types of retirement plans out there. Most of them allow you to contribute. Some only have company contributions, but most have a mix between your contributions and your employer's contributions, right? So it's also very important that the contribution limits will be specific to the type of plan that you have access to. I mentioned 401ks already. There's 403bs, there's simple IRAs, traditional IRAs, SEPs, and so on and so on. Have a conversation with the person in your HR department or the person who helped you set up your account to understand what your maximum contributions might be as you head into the new year. Next up, double check things. Who owns all your stuff? You do, right? You think you do, but are you absolutely certain that the assets you own are titled the correct way? There are two very important things that I really want you to double check as you head into the next year, and those are, 1, the ownership on your accounts and your properties. The most common places I want you to check are your financial accounts, like your checking, your CDs, your savings accounts, your brokerage accounts, things like that. And also check your real estate properties, like your home and your land, anything owned with you, spouse, siblings, whomever. The reason we check these things closely is that there are assets that oftentimes go to the next person or to your children without going through your will. A lot of times these assets transfer via title versus a beneficiary. And the way that the title is defined also determines the specifics of how it transfers. I won't dive into the details for this video because it can get a bit confusing, but what I want you to pay attention to is how each of these things in your life is owned. And if you think it should be owned by just you, be sure that it's titled that way. If you think it should be owned jointly or with a spouse or a sibling or whomever, then make sure it's titled that way. If you have any questions whatsoever about that, reach out to your attorney or your financial advisor or whoever it was to help you set that account up or buy that asset. So clarifying and double checking the ownership of your assets and properties is always a good thing. The second thing I want you to pay attention to is beneficiaries. The most common places you're going to see beneficiaries are your retirement plans and insurance policies. I can't tell you how many times people end up with major regret because their life changed somehow, but they neglected to update their beneficiary. Divorce is the most common thing we see, and there's nothing more humbling and frustrating than having to explain to your new spouse why your former spouse is still listed as your beneficiary. Or even worse, is having somebody who fully expected to inherit someone's account, and now that person is deceased, and it comes to light that this person is not listed as beneficiary because the former owner never got around to updating the beneficiary. It seems improbable, but trust me, it happens more times than you might expect. Don't be that person. It's super easy to check and update this information. In today's world, most of us can do it online, but certainly if you need to, simply contact the person who set that account up for you and ask them for help if you need it. Check your risk. I'll keep this one brief because I'm not an insurance guru. Let me rephrase that. I know a lot about insurance, but when it comes to property and casualty and how it relates to the property that you own and that is producing royalties, I suggest that you leave that up to the expert that you rely on. Your agent, the agent who has helped you get coverage for that property, should be somebody that you should call when your royalties really start pushing up into higher levels. It's good to touch base with them anyway, but there's no reason that you shouldn't be in touch with them at least once a year. Regardless of what the impetus is for you to reach out, I strongly suggest you do that and let him or her know what's going on at your property these days. You're going to want to ask them two simple questions. Am I adequately covered? And do I have exposure that cannot be covered by my existing policies? We have people ask us whether they should set up an LLC or some kind of entity to protect their property from lawsuits or liabilities. That is a super in-depth topic and one that I would highly recommend you involve an attorney to answer. Setting up and transferring your property into entities such as this is not something that you do on a whim or lightly or without consideration. There is time involved, and there are certainly legal costs and transfer taxes and other things involved in doing this. If you're worried about livestock getting loose and causing a problem with a neighbor, or snowmobiles or four-wheelers that are going across your property, those are valid risks for sure, but the liabilities associated with those might be able to be covered within your homeowner's policy or even within an umbrella policy, probably through your same agent. But there might be other risks outside that those policies just don't cover. Each property is different. A simple example would be a property that has an active well pad on it versus a property that has no surface or activity or even a pipeline through it. They have totally different risks. I believe there are a lot of good insurance agents out there who welcome a conversation like that with you to make sure that you're properly covered. And they would also be the first to tell you, or should be the first to tell you, if there were outlying risks that you still should be concerned about. The easiest way to look at this is to have that conversation with them first. And then if you feel there's still something out there concerning you, your next conversation might be with an attorney. Legal stuff. Yes, that's right. As equally as exciting and important as taxes. Legal matters are always something you should be on top of. I cannot emphasize enough that you are certain about the legal structure around your life. Most of us have simple wills that dictate what happens to our assets when we're gone. But as I mentioned earlier, some of those assets will not flow through the will, but instead go directly to another owner or owners, depending on how that asset is owned and titled. Staying focused on landowners who are receiving royalties, I want to advise you to focus on 4 things. 1, do you have a will, and is it up to date? If you don't have a will, please put one together ASAP. If you do have a will, but it's been quite some time since you created it, then please double check it. Make sure that it's still accurate and consistent for whatever it is that you want to do with your assets. Number 2, make sure the following are consistent with your wishes. Title and ownership of assets, the beneficiaries on various accounts, and your will. Make sure all 3 of those are working together. Third, do you need an LLC or a family limited partnership? Consider the benefits along with the costs and drawbacks first. If you have one already, are you running it like a business and using it as it's designed to be used? And the 4th thing I'll mention is get your family engaged. Do they know your wishes? Are they able to take ownership and manage these assets if and when you're out of the picture? Are their intents your intents? And do they understand how these assets work enough to be able to govern or manage them when you're gone? That's it for today. We've covered a lot, and I hope by now you have a nice list of items to go through to make sure that you're entering into the next year with a smile on your face and confidence that you have your financial matters well in order. As I mentioned, there's a part 2 to this video, and I'm really excited about that one because I'm going to have all kinds of graphs and charts for you to look at, which is great, but this one's going to be focused mainly on how to manage those checks as they're coming into your household each month. We get a lot of questions about that. Now, I know we did a video where our friend Bill Rourke talked about something that he liked to call the 50-30-20 rule. And so we're going to dive more and more deeply into that and give you a good handle on how to take the chaos out of those royalty checks and provide some nice order and efficiency on how to manage that money in the future. I hope you can find time to watch part 2 coming up soon. It's going to be chocked with great stuff. And as always, if you have any questions or if you'd like to talk to one of our Stonehouse advisors on how they can work right alongside of you to get a lot of these things that we talked about today done for you and executed for you, just click on any of our links And that should bring you to an easy way to contact us. So we'll see you on the next one.